If that's you, you'll need to use the Accruals Basis of Accounting instead. This week, the Accruals Basis. Hey guys, welcome back to Accounting Stuff, the place where we discuss all things accounting. Up until now, we've been talking about some basic accounting theory. Last week, we talked about the cash basis of accounting, and this week, we're going to talk about another super important method of accounting, the accruals basis of accounting. The accruals basis of accounting is considered to be a much better method to follow than the cash basis, because there's so much information you can extract from it. I'm going to explain why. Most businesses, when they're starting out, tend to cash account because it's easy. But have you ever wondered how the big companies like Apple, Amazon, and Google do their books? Or pretty much any household name? They all have one thing in common. They use the accruals basis of accounting. If you've never heard of it before, don't worry. I'm going to explain it all to you right now. Don't forget to stick around to the end because I'm going to talk through some of the main advantages of using this method and also the reasons why most businesses starting out tend not to use it. Let's get cracking. In the last video, I explained the pros and cons of the cash basis of accounting. If you missed it, there should be a link somewhere up here. With the cash basis, you record your revenue once you receive the cash, and you record your expenses when you pay that cash back out. It's a great way to do your books, and it's simple. And that's the reason why it's an approach used by many small businesses and individuals for personal finance. However, there is one big problem with this accounting method. It can be really hard to work out your business's profitability, particularly when you want to work out how much profit you made for one particular point in time, like 1 month of the year, for instance. And that's because of the timing differences between when you recognize your revenue and expenses. I'll give you an example of this in a moment. The accruals basis of accounting solves this issue. Revenue is recognized as it's earned, and expenses are recorded as they are incurred. It's a way of recording the substance of transactions, and that makes it a much easier way to record the performance of your business over a specific period in time. Let me explain. Let's go back to that example of a baking business selling a cake that we discussed in the previous video. The ingredients of that cake cost us $10 to buy, and we sold it for $25. That leaves us with a profit of $15. Now, let's imagine a scenario where we sell a cake to a customer on the 25th of October. The customer has 7-day payment terms, so we don't receive the cash until the 1st of November. Under the cash basis of accounting, the revenue would be recognized on the 1st of November because that's when we receive the cash. However, under the accruals basis of accounting, the revenue would be recognized on the 25th of October because that's when the substance of the transaction occurred. That's when we physically handed over the cake to the customer. Now, let's also imagine that we baked that cake using ingredients that we purchased a month ago in September. Under the cash basis of accounting, we would have recorded the expense in September because that's when we paid the cash for the ingredients. However, using the accruals basis of accounting, we would instead record that expense in October because that's when we sold the cake. You can see that under the cash basis of accounting, we recorded a loss of $10 in September and a profit of $25 in November. This timing difference that you can see here could cause us a real headache if we wanted to look back in time and review our performance in October because we wouldn't see any profit there. It might not seem that complicated for this one example, but imagine that we'd sold 100 cakes and they all had timing differences just like this one. It would be a nightmare to work out our profitability for a particular period in time because we didn't record the substance of the transactions as they were incurred. However, the accruals basis of accounting neatly solves this issue for us. We record both the revenue and expense in October, so we can see the profit of $15 in October, just like you'd expect. Our revenues and expenses are aligned with each other in the same accounting period because in the accruals basis of accounting, we apply the matching principle. The matching principle simply states that revenue and all expenses incurred in order to generate that revenue need to be recognized in the same accounting period. This is a key differentiator between the cash and accrual methods of accounting. The matching principle makes it easier for us to objectively analyze results because you can accurately measure your profit over time. Now that we've clarified the accruals basis of accounting, let's run through some of its pros and cons. First of all, like I just said, it applies the matching principle, so a business's profitability can be accurately measured for specific time periods. It also measures accounts receivable and payable, so you can build a picture of your financial position. And it's accepted under GAAP and IFRS, so it's possible to produce financial statements under these principles and standards. On the other hand, however, the accruals basis of accounting doesn't explicitly track cash flow, so this needs to be calculated separately using the direct or indirect method. It's also more complicated than the cash method of accounting because you have to make estimates and assumptions. This can be unsuitable for small businesses, hence why many of them choose to adopt the cash method of accounting instead. If you're deciding which of these methods to use for your business, then you'll need to weigh up the pros and cons of each in order to come to a decision. Both of these methods are usually allowed for tax purposes, although the cash basis is normally only an option if your revenues are below a certain threshold. You can Google what that threshold is on your tax authority's website. It's also important to note that whichever method you choose could impact your tax payments by bringing them forwards or backwards, depending on your situation. However, in the long run, both the cash and accruals methods tend to produce the same result. Most startups and small businesses tend to start off with the cash method of accounting because it's easier to apply and it's a good way to track cash flow. However, if and when those businesses continue to grow, there may come a point where it makes sense to make the switch to the accruals basis of accounting instead. That's all for today. Thank you for watching. If you found this video useful, give it a like, subscribe if you haven't already, and hit that little bell to be notified when the next video is out. I'm thinking of doing some longer form videos where we work through some practice questions and model answers to reinforce these ideas. If you think you'd find that useful, let me know in the comments below. I've had a great time learning with you today. Till next time.